Hey everyone, it's Mike Bond with Hard Money Mike. Today I just want to go through what is the big difference because it's asked a lot. What's the difference between a traditional, like the Wall Street fix and flippers, and a true hard money? We've gone through some of these videos before, but it keeps popping up, so I know we need to address this again. So let's start with the biggest one out there, which is the fix and flippers. Those are the Kiavis, the RCNs, the Lima ones, the big Wall Street money. What do they do, and what's the difference between them and hard money? The biggest thing is they have a box. They're corporate money, so they need to know exactly what fits in their box. Typically, that comes down to what they lend on and what they don't, who they lend to and who they don't. So typically what you're going to find in their box, especially on the fix and flips, is they're going to look for standard single family properties that need some work. They're also going to look for people who have decent credit. So you're going to have a decent credit score. When I say decent credit score, 680 and above. The higher the credit score, the more they're going to lend you or open up their coffers to give you some more money on that deal or even other deals. So the credit, they're going to look for funds. So they're going to need some funds for down payment. Reserves, typically reserves are like 6 months of payments in an account that you have access to make those payments during the process. They may even require some extra reserves depending on where your credit score is. Most of their deals are going to be, we'll just call it larger deals. They don't really go under 100,000, but they really like the 250 and 350. Remember, they're trying to sell all this, package everything up and sell it off to Wall Street in one bundle. So they want everyone to kind of look the same, every property to be within a certain criteria, and loan to values. Typically what they're going to do is what you'll see is they'll lend up to 75% of the after repair value. So what it's going to sell for, what it's going to be worth when it's all done, or max out starting at 90% of the purchase price and up to 100% of the rehab. So they can fund the majority of it. What they're not going to fund is either that 10% or 20%, depending on where you fit in their box again. And they're not going to fund, closing costs, interest payments, anything like that. So even if you have a great deal and it's under 75%, they're not going to give you that extra monies for any of those other things. Remember, you have fit in their box with credit, loan to value, property, and last experience. They're looking for people who have done, 3 to 5 deals. Not saying they won't do deals with someone starting out. They'll just require either more reserves, maybe a cosign or something like that. They are great when you fit in their box. Why? Because they can repeat this. They have all the money in the world to help those who have the cookie cutter deals, cookie cutter person who is looking to do this. I recommend, they're destroying the market with rates in a good way for you guys out there. They're doing a great job with rates, points, cost, and even quickness, how they do this. They're really dialing this in. And that's where the traditional, Wall Street, not traditional because they haven't been around that long, lenders are doing such a great job for you as the investor out there. So when you fit in their box, have that single family or maybe even a duplex up to 4, but you fit in their box with loan to value, credit, reserves, and experience, you're going to be golden there. You're going to find the best rates and the lowest cost. And I'd still shop around because, between the Kiavis and RCNs, Lima ones, whoever else is out there, all the big people out there, backflip, doing these kind of loans, they'll have a little uniqueness, but you always kind of check to make sure you're just, paying a point instead of 2 points. I see some people paying 2 or 3. Shop around, look around. When you're in that box, that's the perfect place to be. But now, how about everything else? How about if you don't fit in that box? So maybe the area is too small. Maybe the deal is too small. Maybe it's a unique property. Maybe it's even over 4 units. Because remember, they're looking for 1 to 4, really like that 1 to 2. So if you have a unique deal, maybe there's some land involved that you're going to split off. The unique deals is where really the money is. And when you're looking for those kind of unique deals, that's where hard money, because hard money is more about old school, talking to people, learning what they do, seeing if the deal makes sense. That's what hard money lenders are looking for. Does the deal make sense? Does the loan to value make sense? Does the exit strategy make sense? Anything that makes sense, doesn't matter if it's a land deal, doesn't matter if it's something larger, smaller, in a unique area, unique property, hard money will look at those kind of deals. Number 2, credit. Hard money is not credit score driven. Like I said before with the box lenders, you're going to have a 680 and above. Hard money lenders don't look at score. They do look at credit because they want credit to be like you're paying on time. But we all know in this business, sometimes using credit cards, using other lines of credit impacts your score while you're doing a project. So it might deflate your score for a while until a project sells. Hard money lenders understand that. They look at credit, not credit score. They'll look at your history and everything else you've done. Also, if you're looking out of the box and you have a great deal that you've found, maybe it's 70% ARV and below, and we see them all the time. So everyone who says they're not out there, they are. You have to look, you have to be one of those people who's persistent and consistent out there looking for deals. We've just did one that was 50%. We're doing one that's even lower than that this month. And we're all in, which means we could fund 100% of that. 100% of the purchase, 100% of the rehab, 100% of the closing costs. So if you're looking for and have a good, unique deal, you're not going to have to come up with all that money that you do with box lenders. So with private money, it's all about the deal. How does the deal look? How does the market look for that deal? How is your credit? How are you just paying on credit? How does your experience does matter, but it matters a lot less the better the deal you have. Next, if you're looking at BRRRR, if you're looking at 100% BRRRR financing and you have a deal that's 75% or below after repair value, hard money is a perfect fit because typically, as long as you're pre-approved for your traditional take-out loan, remember BRRRR has two loans. It's the buy loan and it's the refinance loan. If when you get into the property, you're already set up, qualified for the long-term loan, you're going to be able to get 100% financing and hard money. So locating and having hard money for every deal that you look at is probably not what it's used for. If you find the cookie cutter deals, that's where you work with the box lenders, the Kiavis, the, like I said, backflips, all of those people that are out there. But if you have a unique deal, or you have a deal that's, small, second position, need to finish a project, something you need to split off, cross collateralization because you need that extra loan to value to get the deal to work. When you're looking at uniqueness and when you're looking at finding a good property that just needs to get done and you may need to make some money, that's where hard money comes in. Can hard money compete with the fix and flip lenders? Typically, they're going to be a point or two higher on the interest rate and maybe a point higher on the closing costs. But they're going to be a lot easier to work with. Not a lot of tax returns going back and forth, not a lot of paperwork going back and forth. If you want to close fast. That's why you need a hard money lender. I just wanted to run through this because we get a lot of different calls. Like, what's the difference from here or here? Why don't I just go there? Like I said, if you fit in the credit, property, LTV, reserves, all those kind of things, if you fit in their box, that's where you should be. But you should still shop around with all the lenders out there and making sure you get the best deal because every penny counts in real estate investing in this time. Now, but if you're looking for something that's going to take, someone with a little less experience, someone who has a 100% deal that wants to be funded because the loan to value is so good, maybe their credit score at this point in time is not what they need, that's where you go to a hard money lender because you can still get even 90 and 100% with a credit score below 680. I hope this helped today. Check out our website. We have a couple great downloads that you could use, like the cash flow worksheet or the quick deal analyzer. These tools are there to help you make sure the deals are good because if a deal is good for you, it's going to be good for a lender. Thanks, Hunt. Let's go make some money in real estate.